Thank you for tuning in to our Retirement Education Center YouTube channel, where on this channel, we believe in providing you unbiased advice that will help you maximize all of your retirement income. Now, on our channel, of course, we do not believe in providing you any silver bullet strategies or glorifying any type of one product. But what we do believe in are holistic concepts that will help you retire with confidence. Now, this time of the year, many people are going to have to take money from their retirement accounts, like their traditional IRAs or maybe even their 401k, due to RMDs. Now, RMDs can be very confusing, and they are always due at the end of the year by December the 31st. But with so many regulatory changes, Andrea, and the taxation of these RMDs, people can become very confused and they can become very anxious about what they should be doing. I have these conversations with my clients all the time. So today I'm going to cover the 5 most basic and critical things that you need to understand when you are going to be faced with your required minimum distribution. So stay locked in. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Concepts videos. These videos were created to help to make the difficult and confusing retirement process simple.
Absolutely, Andrea, because with so many retirement concepts out there, so many retirement strategies, and of course, so many retirement products, it can certainly become very difficult for consumers to digest it all. That is why we're so fortunate that we're able to work with a team of expert advisors to help us build a comprehensive financial roadmap that's going to let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Now, Carson, required minimum distributions can become very confusing when people know that they have to take out money for their retirement accounts. So what should people know when they're faced with this mandatory distribution?
What people should know, Andrea, is that they should absolutely take this seriously, because they must take that amount out, or they can be hit with a 50% excise penalty on the amount that should have came out, on top of the taxes that's owed as well. So just imagine if you're in a 22% tax bracket, Andrea, you can pay literally 72% on the amount of dollars that should be coming out of that IRA account. So you certainly want to make sure you take this serious, and you want to know some of the implications that goes along with taking out your required minimum distributions as well. And so that's what we're going to be discussing today. We're going to go over 5 key issues and 5 key facts that you should know about your required minimum distribution. But before we do that, there are always 2 rules to retirement income that we like to give you. And Andrew, what are those 2 rules?
Well, rule number 1 is to never run out of money. And rule number 2 is to never forget rule number 1.
Okay, so let's talk about 5 key elements to your required minimum distribution that you need to understand in order to make sure that when you are faced with this particular mandatory distribution, you're ready.
So Carson, can you first provide a concise definition of what a required minimum distribution is?
A concise definition?
Yes.
Okay, so are you trying to say I'm long-winded? A concise definition of an RMD, or required minimum distribution, Andrea. Basically, Andrea, if you have a traditional IRA, you have a rollover IRA, a SEP IRA, a simple IRA, or any type of qualified account, you're going to have to take your required minimum distribution out the year you turn the age of 72. Now, that age could be 70 and a half, Andrea, for people who fall under the Secure Act. So, Andrea, if you were actually born before July 1st, 1949, your required minimum distribution age would be 70 and a half. Now, due to the Secure Act, if you were born June 30th of 1949 and later, your required minimum distribution age is going to be 72. And that year, you're going to have to take that distribution out by April 1st of the following year. Now, if you decide to do that, one thing to make note of is that you're going to have to take 2 distributions in that year. So if let's just say, for example, Andrea, and I'm trying to be concise, if you turn 72 in 2022, you can take that distribution out, Andrea, by April 1st of 2023. But you also then would have to take another distribution out by December 31st of 2023 and every year thereafter at December 31st of the following year. So just keep those things in mind. It could be the right situation for you or may not, but just know that if you do wait to take that distribution by April 1st of the following year, Andrea, you're going to have to take out 2 distributions in that other year. So be careful about that part of it.
All right, Carson, great explanation. But another question that people have is, what are they basing the amount on needed to withdraw that?
Another good question here. So, Andrew, what they're going to look at is the prior year value of your IRAs. So they're going to look at the prior year. So let's say, for instance, you turn 72 this year in 2022. They're going to look at 2021 values of your IRA and base the amount of required minimum distributions that you're going to have to take out. And then they're going to also use an IRS tax life expectancy table to determine the amount as well. So what they're going to do, Andrew, they're going to take the amount of your IRA value and divide that into that IRS life expectancy factor to determine the amount that you have to take out for that year. Now, one thing that I want to make note of too, that may be a little fun fact here, the IRS did increase the life expectancy factor table for 2022 due to the fact that people are living longer. So that's going to have a positive effect, Andrew, of people taking money out of their accounts because the amount that they're going to have to take out is going to be reduced. So just a little fun fact there.
So Carson, another question that people are asking is, can they roll over their RMD into another tax deferred account?
Yeah, this is something that you have to be aware of here because I've been asked this question many times from my clients, what to do with my RMD. Can I roll it over to another IRA? What can I do with it? Well, the one thing you have to make note of is that no, you cannot roll over that RMD into another tax deferred account. But what you can do is be efficient with it, because a lot of people may have a position in their accounts that they don't want to sell out of. So you can roll over that RMD, Andrew, into a brokerage account. Yes, you will still have to pay taxes on the rollover amount from your RMD. And at that standpoint, now you're in a brokerage account. You may be in the same or similar positions that you were in, therefore not taking a full realized loss if you're in a down market, and continue to hold those similar positions in a brokerage account. And the difference now, Andrew, is that you're not going to be taxed on your ordinary income on the gains anymore. You're going to have that more favorable taxation from capital gains and from your qualified dividends of 0%, 15%, or 20%. Depending on your income tax bracket. So that's one of the things that you can be aware of. Another thing that we also help clients understand too, Andrew, is that we may have some money sitting in cash to as an estimate amount of what they may have to pull from their retirement accounts for RMDs. Therefore, if we're in a down market, it's not going to be a situation where we do have to sell out of any positions and take that full loss on those positions, but we can simply have cash on the side to pay what the estimated amount of your required minimum distributions may be as well. One other note that I will make too is that some people want to take those RMDs and just convert it into a Roth IRA. You can't do that. You have to take, you have to take that RMD first. And then you have to take an additional amount that you want to convert for that Roth IRA. So you can't just take the RMD, pay the taxes on that amount, and convert it to a Roth IRA. So these are some very unique things that you have to be aware of. So you really do need to work with a qualified, educated advisor who's going to help you understand some of the intricate details of your required minimum distribution.
Well, Carson, another question that many people have is, do they have to continue taking RMDs from a deceased spouse account?
Another very good question about RMDs. Now, Andrea, this is a very unique situation if you're talking about a deceased spouse account. Now, one of the things that you have when you're a deceased, when you're a spouse of someone who was taking RMDs, is that you're under what we call an eligible designated beneficiary. And a spouse has a very unique situation that no other beneficiaries actually have. They could either take that IRA, Andrea, and keep it as an inherited beneficiary IRA. And this may be beneficial to someone who's younger, who may need distributions from that account, but they're under the age of 59 and a half. But if it's actually kept as an inherited beneficiary IRA, they would not be taxed with an early withdrawal penalty of 10% because it is actually in an inherited beneficiary IRA. Now, once they get past that age, Andrew, they can switch it into a regular IRA into their own account. So that's just one thing to make note of. So you can make a change after you pass that 59.5 status. But the more common thing that may be the case is that a person can literally take over that IRA and roll it into their own IRA and take possession of those funds. So let's just say, for instance, your spouse was age 72, taking their required minimum distributions. You're age 65. You can take those. You could take the account value, roll it into your own IRA, and delay taking those distributions until you reach your required minimum distribution age. So it's a couple of different things you can do with that account when you're a spouse that others can't do. But again, like I say, this can be very confusing. So you do want to work with an educated advisor who can advise you on what's more appropriate for you.
Now, that was some very good information. But my last question is, if someone has multiple IRAs, do they have to take RMDs from each one of those accounts?
Andrea, that is a very good question. And again, here, this is a yes and no answer, because you do have to take your required minimum distributions from each IRA. But what they will allow you to do is look at an aggregate amount and take the actual amount from all of those IRAs and take it from one. So they can combine everything that you have to take from each IRA, and you can decide to take that required minimum distribution amount from one account. Now, the easiest thing to make it less cumbersome, Andrea, is that people should maybe, if they have 3 or 4 different custodians and they have IRAs here and there, maybe they should combine it into one custodial account to make things simpler. But for like my clients, they may have an annuity IRA, and they may have an annuity IRA from a different company, depending on what the situation may be. So they may have different types of annuity IRAs. They may have different types of holdings within their investment accounts. And so we have to look at, do we take it out of this IRA for 1 year? Do we take it out of multiple accounts, or take it all from the IRA from the brokerage account? There are a lot of different things that we have to take a look at when it comes to our clients, and therefore it may not be so simple as combining all the IRAs into one account. So when that is the case, Andrea, you are allowed to take a look at an aggregate amount from your IRAs and simply just take it from one account of the value for all of them. So very good question there.
So Carson, that was extremely helpful. So thank you for your insight on that topic, and thank you for watching. And if you felt this information was beneficial, please like this video and share with others.
So I really do hope that the information that we shared with you today regarding your required minimum distributions is going to be helpful to help you have a better strategy around those mandatory distributions that you have to take at the age of 72. Please understand that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for a fiduciary financial advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in the description below and go ahead and schedule a 1-hour complimentary consultation with us today.
For more information about this topic or any of the other topics that we've shared in our other videos, please feel free to reach out to our office or leave any questions or comments in the section below. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.